How best to raise seed funds for your business, venture capital versus loan. Your startup company may need funds to get started in its expansion. This fund that you seek can be gotten from different sources, part of which are venture capital and loan. Sometimes it can be a tough decision when you have to choose which method is best for you to use to find funds for your startup business. Here, we have the two together and will examine their advantages and disadvantages. Hopefully, this will help you to decide which method you want to use to raise seed funds. Without delay, let's start with the definition of and then move on to the next. Venture capital. What is it? Early-stage startups and startups with little, or no business history, but high growth potential raise money from venture capital, VC, a type of private equity. Venture capital funds buy equity in startup companies in exchange for funding and operational and technical assistance. VC investors frequently take an active role in the management and support the executives' growth-oriented actions. While VCs focus on advising new businesses, startup founders may have an extensive understanding of their chosen industry but may not have the ability to create a successful business. How it works. Firms that specialize in venture capital finance startup businesses in their early phases of growth. A VC firm often accepts a minority ownership position of less than 50% in exchange for capital. The objective of a venture capital fund is to raise the startup's value before profitably exiting the investment through the sale of their stake or an IPO. Different parties take part in the VC industry. Some of them are 1. Entrepreneurs. 2. Investors. 3. Venture capitalists. Below are some of the advantages of getting seed funds from venture capitalists. 1. You do not exactly have a debt. You don't have to pay back any money you get from venture capital sources. In reality, it is a transaction or deal that is completed after receiving funds, and allocating equity, much like you are offering equity to a venture capitalist. 2. There is no need to have an existing business presence. VCs seek out companies that are still in the development stages or that have not yet established a strong brand. Since venture capitalists eventually receive a piece of the business, it's frequently crucial for them to believe they can influence the decision-making process. Less than a couple of years of business experience is excellent for this sort of financing, and the younger the company, the better. 3. You can gain expertise for your business. Many venture capitalists view themselves as businesspeople, and some may even have prior experience in the sector they're looking to invest in. As your business develops, your venture capitalist acts as a useful resource for knowledge and guidance. 4. No monthly payments. Unlike loans, whereby you will have to repay the money you borrowed per month, this one doesn't require you to do so. A venture capital company will invest in your company in exchange for stock in the enterprise. This indicates that, unlike personal loans and small business loans, your company won't be required to make ongoing payments. As a result, your company will have more working capital available to reinvest in developing your products, expanding your workforce, or growing your business operations. Moving on, what are the disadvantages of venture capital? Having looked at the advantages of venture capital, let's look at some of the downsides of venture capital below. 1. High company valuation. The process of determining the overall economic value of a company and its assets is known as company valuation, sometimes known as business valuation. To assess an organization's or department's present value, all facets of the business are considered. Even if it doesn't take the form of traditional loan payback, venture capitalists still want to see a profit on their investment. At the beginning of your firm, you must demonstrate a high company valuation, which might be quite difficult if you haven't yet launched. You must demonstrate that your company is likely to succeed enough to provide a gross internal return rate of at least 30% if you want to attract early equity investors. 2. A portion of your company's equity will belong to the venture capitalist. In exchange for the venture partner's investment, you normally agree to sign away some equity from your business when you partner with one. Venture capitalists occasionally own approximately 50% of startups. In the future, you won't have as much discretion to convert equity into capital, if you end up becoming a minority stakeholder in your own company. 3. Extensive proper diligence is necessary. Since they are investing money from outside contributors, venture capital partners must vet startups. There are two phases to this. Your innovation and business foundations are initially assessed to see if there is a market and whether the business can be measured. The venture capital partners will then analyze the background of your team and the financial and legal standing of the business in more detail. 4. Some VCs tend to be very selective. Venture capitalists tend to be picky, so they often close a handful of deals each year. Venture capitalists often look for companies that are likely to offer better returns on their investments. Markets can be particularly challenging in some sectors. For example, for large technology companies and companies in the healthcare sector. This means that even if you have a very compelling offer, you cannot assume that you will close the deal. Before we continue, if you are getting values from this video, kindly help us to put this video in front of many that may need it by clicking on the like button, and share this video with people that it will be of interests in your network. Welcome back and thanks for staying too. Let's talk about loans. Loan. What is it? Businesses and banks, or other lenders enter into lending contracts known as business loans. Businesses require capital, either to start up and start making a profit or to simply fund operations. Banks and lenders are eager to lend them the cash up front as long as they repay it on time and with interest. For companies with an established presence, business loan options can be a good source of capital. The same as any other funding, it depends on your own financial needs. Even yet, business loans are frequently more flexible than venture financing, making them a better option for your company. Advantages of business loan. Below are some of the advantages of business loans. 1. You have the option to different types of loans. One good thing about business loans is that you are not limited to just one kind of loan. Different types come with unique options and advantages to your business. Some of the kinds of loans that you will be open to including term loans, SBA loans, and fixed asset loans. These are just a few of the loans that you can apply for when you go seeking to fund your business with loans. 2. Flexibility on how to use the loan. With many types of company loans, there are no restrictions on how you can use the money. The lender doesn't care whether you need to expand your marketing budget, order more products, pay vendors or stay ahead on the payroll. 3. You retain your business equity. With a business loan, the lender expects interest payments as repayment, so you don't lose most of your business. Retaining a majority stake is important if the business is already established, and may have previously given up some stake. And finally, let's talk about the disadvantages of business loans. The following are the disadvantages of business loans. 1. There is a possibility that you will become subject to credit check. Before approving a loan, many major, traditional banks may do a credit check, and have strict credit requirements, demanding a good personal or corporate credit score. 2. The bank or provider of the loan will need to see your business track record. Eligibility for some corporate loans through large traditional banks may require a track record that includes several years of profitable operations. If your business is new, and doesn't have the reputation you need for venture capital, it can be difficult to get financing. 3. Difficulty in applying for loans. Applying for business funding takes time. Getting a business loan is much more complicated than a personal loan. All the documents that the entrepreneur fills out on the application form are checked by the bank, which will determine if the company is eligible for a loan. A point system is used to determine if a loan is eligible and must be balanced as new information is received. This is a long and tedious process. 4. Payment at the end of every month. If there's one thing about taking loans for your new business, it is the fact that you have to pay the lender at the end of every month, and this may greatly affect your business monthly plans and others. Our take. Venture capital seems to be the best option since you're just starting your business. The reason is that with capital, the whole process of getting money is much easier, and then in case there is a loss, you don't have to pay back money that you lost in your business. If you're thinking about equity, you could think about what your business will be in the next 10 years. However, the choice is for you to make when it comes to funding your startup company. Besides, to tell the truth, both have their merits and demerits as already seen above. We have come to the end of this video. Venture capital or loan? Which of them do you think is a better fund type for businesses? Kindly share your thoughts with us in the comments section. Thanks for watching. Don't forget to subscribe to our channel, turn on your notifications so you will be notified when we post a new video.